Welcome to the Lend Academy podcast, episode number 239. This is your host, Peter Renton, founder of Lend Academy and co-founder of the Lend It Fintech Conference. Today's episode is sponsored by Lend It Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th at the Javits Center in New York City. Lending and banking are converging, and Lend It Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lend It Fintech. Lending and banking connected. Go to lendit.com/USA to register. Today on the show, I'm delighted to welcome Freddy Kelly. He is the CEO and founder of Kudos. Now, Kudos is a really interesting company. They what you would call an alternative credit bureau, or as they say in the UK, a credit reference agency. They're using the power of open banking to be able to bring more people into the credit system, more people, expanding the credit box for a lot of lenders, because they're not really focused on credit history like the traditional bureaus. They are using the power of open banking to be able to connect. People can connect their banking information so they can get an accurate credit assessment on a much broader cross-section of people. So we talk about exactly how they do that. We talk about the different data points they're using, how they, the type of lenders they're going after and who are using their product today. And we talk about, just some of the attitudes towards open banking and the success rates that they're getting. We talk about some of the new interesting relationships they have set up and their plans for expansion beyond the UK and much more. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Freddy.
Thank you very much for having me.
My pleasure. So I like to get these things started by giving the listeners a little bit of background. You've had an interesting career but you've been doing Kudos for a few years now. But tell us what you did before you started Kudos.
So I'm a software engineer by training, I guess. So I studied computer science in the UK. I moved to the West Coast of America after graduating and went to work in sort of fast-growing tech startups. So I started working for a business called Bitnami back in 2013 when they were going through or just finishing up with Y Combinator. And that company was building sort of deployment systems for big cloud platforms like Amazon and Google. So I spent a couple of years doing that. I then landed in my first, what I now know as fintech gig at a business called TXN, which was an analytics startup that was looking at the problem of understanding consumer spending behavior through the lens of their bank transactions and trying to repurpose that information, if you like, for big retailers so they could understand what their customers were likely to do next. So that was where I really sort of cut my teeth with fintech and this transactional data. I then got the opportunity to join a program called Entrepreneur First in London, which is a pre-seed startup accelerator. So I sort of jumped on a plane and came back to London. And it was about that time that I suddenly realized that, or rather painfully, I guess, realized that I didn't have a complete credit history. And it was through having to provide bank statements in printed form to my landlord to prove that I was able to pay the rent that I sort of hit upon this problem. And having had this experience using transaction data in a much more automated way, the idea for Kudos was really born in bringing those things together and trying to make a much more effective, accurate credit reference agency, which is what our business is all about.
Right. Okay. So then let's just dig into that. So maybe when you got started, I said a few years back now, but what was the original mission, and does that mission has remained the same today?
Yeah. So we want to make credit more fair and accessible for everyone, but particularly with a focus on those that are excluded from financial services. So there are about 5.8 million people in the UK that are excluded from mainstream credit, depending on what your definition is, that number changes. But essentially, the way we look at it is a lot of people currently get rejected for loans or credit cards or whatever else because their credit history doesn't portray them in a fair and accurate way. And indeed, they maybe not get rejected, but they end up paying a much higher price and a higher interest rate. And if we can build a product that perfectly predicts risk, obviously that's the dream, then those people shouldn't end up paying. So what we're trying to do is get as close as possible to perfect by using this new source of data to serve every customer, but particularly those that are financially excluded. So that's really our mission.
Okay, so then, and what is the kind of data that you're actually, can you maybe just dig into that a little bit about what data you use specifically that is different from the main credit bureaus?
Yeah, so a traditional credit bureau, depending on which one you look at, will use effectively your past borrowing performance as the primary indicator of your credit risk. So if you've never borrowed money before, then you don't really have a credit score. It's not like you sort of have it to lose. You have to gain it in the first place by taking out credit cards, things like that. And so if you've never used a credit card or a loan, then you maybe don't have a credit history. And there are loads of other different examples where people having impaired or non-existent credit files where they really should be able to access credit. What we do, instead of looking at that as our source of input, we look at open banking data or PSD2 data. So what that is basically a new mechanism that gives consumers the ability to securely share data with a third party such as ourselves through an API, so a programmatic interface. We get effectively their bank transaction data over an extended period of time, so typically 2 years. And we use that data to score the consumer and provide a decision. And that score is derived from historic information we've seen from other customers. So our model looks at essentially the bank transaction data or open banking data of customers and then how those customers went on to behave. So did they repay back their loan or not? And it looks at those data points at an enormous scale. And then using that inference that we've built up, we can then predict for a new customer that's sharing their data with us whether they're going to repay. And it means that we're scoring them based on their real financial behavior rather than necessarily just their past credit performance. It's a much more forward-looking prediction.
Right, got it. Okay, so then did you start the company? I mean, obviously, open banking has been in place now in the UK for a couple of years. Did you start the company knowing that open banking was coming and you thought this would be a good way to kind of have this data available to you?
Yes, we did. So open banking as a sort of very seed of an idea was actually in existence before what we now know to be Open Banking Limited and the regulatory framework. So there was a project by the Open Data Institute, the ODI, that was part sponsored by Barclays, I believe, that was looking at this idea that data could be open and what about banking data being part of that. And at the same time, or in fact, a little bit before, the European regulator was introducing Payment Services Directive 2 or PSD2, which was a sort of much more high-level overview directive that looked at all different parts of the ecosystem. But within that was this scope that banks should be able to provide access to this data through some interface. And so it was on the horizon, but it wasn't until the CMA order, the Competition Markets Authority here in the UK, that we really put the accelerator on the development of these APIs. And that, as you say, in the last couple of years has seen those come to fruition.
Right. Okay. So maybe you could just step back a second and tell us how it works. I mean, do you operate in the same way that a normal, credit bureau, credit reporting agency would operate? And maybe you could explain the business model and how it works for both the businesses you're serving and then the individuals. Definitely.
So we're regulated in the same way as a traditional credit reference agency, but the model we've adopted is very different. So what would happen ordinarily is you would apply maybe on the website of a lender, and they would take your identifying attributes, so your name, address, date of birth, and they would search in the background for a matching record with one of the three major credit reference agencies, or at least three major credit reference agencies in the UK, and that would return whatever information they have on you, which might be nothing. With our system, the customer is presented a consent window in the application journey. So a little bit like buying something with PayPal or using like a Stripe type checkout. We embed our process into the loan application journey, and the consumer is given the option to use open banking to fulfill their application. And the way that works is, say you bank with Barclays Bank, you would say, okay, I click on Barclays, and then we take you through a normal Barclays online banking login process, or if you're on your mobile, it's the mobile app authentication. And part of that process will involve you saying how much data you want to share over what period of time, and consenting to that. And it's very similar to the processes you might have gone through with Google or Facebook when you're sharing your data on a third-party service. And once we've got that data, we process that and build our report, which is then provided to the lender through API or basically through a programmatic connection. And the consumer, it can then, if they so desired, they can sever that link and prevent us from accessing that data. And they can do that from our interface, or they can do that from their own bank. So it provides a much higher level of transparency for the consumer in a process that they're normally, in some cases, completely oblivious to, or at best, they don't really understand how it works.
Okay, so then I'm curious about how you interface with the existing credit reference agencies. And like, as I imagine, when a person is going through a loan application, this lender is also going to be sort of pinging the traditional agencies. Does it work where if there's no record there, they go to Credit Kudos and go through a system there? Or how does it interface? And I imagine it varies from lender to lender, but maybe what's a typical way that it works?
It does vary. Most lenders will use more than one credit reference agency anyway, irrespective of whether they use our product, and they will combine the different sources to come to their ultimate decision. And so we're no different in that sense. We'll provide an input into their decision, and then they have their credit scorecard, which is the set of business rules that ultimately comes up to the yes or no decision. We are better at serving customers that are typically missed by credit bureaus. So you're right, there's sort of a waterfall there. And if bureau number one or bureau number two doesn't give a response, we can provide an answer where they're unable to. But also for an increasing number of customers, that they use us to fulfill their regulatory obligations to understand the affordability of the credit. So because we're looking at live income and expenditure data for that individual, we can much better understand their ability to repay, which is, of course, crucial in the way that the overall decision is made. And it's something that our regulator, the FCA, has put a lot of onus on firms to better understand, whereas, historically they were able to sort of use statistical data to try and understand at a sort of a high level whether someone could afford something. We're now seeing the regulator push more and more for those lenders to use actual validated data, and short of getting the customer to kind of send in pay slips and bank statements, which is obviously a huge source of friction and pain for for both parties, we can automate that and provide that solution for the lender. So it tends to be across the board with all types of customers, but for various different use cases and different profiles.
Right. Okay. So I know you've been coming to our lended events for a while now, but so are you mainly focused on the alternative lending space? Do you have traditional lenders you're working with? Maybe give us a sense of the sort of the cross section of lenders that you work with today.
Absolutely. So we work with all types. I mean, as I kind of alluded to before, if you can build something that really works for the sort of most hard to reach customer profiles, you generally end up with a better outcome for everyone. And we've certainly found that. So we work with anything from sort of small to medium sized credit unions and alternative community finance providers, right through to major credit card vendors, loans providers, motor finance, and then up to more prime products, so mortgages, secured loans, and tier one banks and mainstream banks, and then a little bit as well in product advice and debt advice and things like that. So the whole spectrum of the market, which is hugely encouraging for us, because we're effectively the fourth credit bureau in the UK, and we're really providing a different product to what's been on the market historically.
Sure. So I'm curious about the consumers. I mean, because there's been a lot of talk about open banking in the UK, and where it hasn't had the level of traction I think that people were hoping. Do you find the consumers that are being presented with your consent journey, is there much reluctance there? Do you find people are now much more open to open banking, shall we say?
Definitely. I mean, there's this kind of, I think there's a little bit of misinformation, because I think from a perspective of a lot of the sort of skeptics in the industry, they were expecting this moment where everyone kind of talks about open banking and it's really cool and everyone's can't wait to use it. And I don't think that moment's ever going to happen. It's in the same way that no one talks about faster payments or BACS payments. They're there and everyone uses it, but it's not what people are talking about. The service is what's interesting, not the functionality or the how. We've seen for the consumer groups that we're looking at, really good conversion rates. So anything from sort of 80-90% at the top end of people consenting to share data. We actually recently conducted some research with one of our partners, Equinity Credit Services, and we looked at consumers' attitudes to adopting open banking in the context of receiving credit. And we found that in the 18 to 35 sector, around 75% of those that were asked were willing to share data. And it really comes down to the value exchange that you give them. So if you can say to the customer, using this process, we'll be able to respond to your application in seconds rather than days, or we'll be able to give you a higher likelihood of being accepted or a lower interest rate, then those types of value exchanges consumers are really willing to share data with. And ultimately, this is data that in many senses is already being shared. And this is just giving them control over that sharing, which is, I think, empowering.
Mm-hmm, mm-hmm. Yeah, that makes sense. So then I'm curious about how you're taking this data, and maybe you could tell us are you using artificial intelligence, machine learning in this? I mean, how you're approaching, how you sort of building your models that are providing a score back to the lenders. What's your approach to the data analytics there?
Yeah, so I'm always wary of sort of talking about AI and machine learning because they've become kind of buzzwords that often misplaced. I think the thing that's really interesting with any type of lending decision, regardless of what data is going into it, is it's a problem of pattern recognition, right? It's what do I know from customers I've seen before that typically meant that they went on to repay or not repay. And so there's some really simple things like knowing that if a customer's defaulted a load of times before, it's probably likely that they might do that again, and that is a really simple sort of knockout rule. But there are more nuanced, complex behaviors that can be detected in much larger data sets that are also highly correlative to outcome. And the way that we get to those behaviors and understand them is using supervised machine learning. So machine learning meaning pattern recognition, and supervised meaning that we know what the outcome is that we want to get to. So the outcome for us is, should we lend, yes or no? The way we train those models is based on historical data. So that bit that I alluded to before is having a database that essentially says this was customer A's bank transaction data before the point that they applied for the loan, and then this is how they went on to repay that loan. Did they repay it on time? Did they repay the full amount? And so on and so forth. And by replicating those sort of layers of data at scale, you can build a model that basically, given any new input of bank transaction data, can sort of compare that to the universe of other customers that have previously been through that process, and then use that to predict whether that customer falls into the yes or no in terms of whether they're going to repay. So that, in kind of really simple terms, is how we look at it. And I guess we're doing it on thousands of dimensions because we have thousands of transactions for each customer. But if we were to do it on, if we take a really simple example of a problem on 2 dimensions, we might have, and this is one from my my university days, so apologies if it sounds kind of silly, but you might have an X and Y axis with height and weight of a group of people, and your problem might be to understand whether they play rugby or a ballet dancer, and you're typically going to end up with loads of crosses in the top left and bottom right, and then your machine learning process is basically just drawing a circle around each of those and knowing that when you get a new observation, which group it fits into. Mm-hmm. So if you can imagine that taking place on 1,000 dimensions or more, that's essentially the process that we're applying, and it's by having good training data that you get good accuracy.
Right, because I imagine the data is you're learning about all the transactions, right? So you're sort of taking in the bank account data and being able to sort of imagine you've got every single person's going to have dozens, possibly hundreds of data points there by looking at that data. So I imagine, once you get the model going well, that you can get a very accurate model because there's just each person has such rich data when you're looking at their at their transaction data, right?
Absolutely. I mean, it's a much stronger signal. What we are comparing to it is quite a blunt instrument when we think about traditional credit data, because it's either there or it's not, and you only really know if someone's bad. You don't know if they're good. If you see what I mean. So right. we only really record that customers don't repay, or they do repay, but we don't record that they're, setting money aside and saving. We don't record that they're financially healthy. We don't record that, their financial trajectory and money management capability over each month is good, or that their ability to withstand some kind of financial shock is there. And all of those things are captured by the data that we're looking at, and even more so. And what we're able to do is predict things like the liquidity of a bank account. So the likelihood that account is going to stay in a positive balance over a certain period of time. And that will capture, up to the second, the behaviors of that customer. So whereas someone who's maybe just had a sudden run of negative transactions would normally not have that data reflected on a traditional credit file, we can immediately see that and show that and catch that behavior. And similarly, on the upward angle, we can show that a customer who maybe has poor perceived traditional credit history is actually on an upward trajectory. They're making sensible financial decisions that are pushing them up. And we can also demonstrate that ability. So for some of our clients, we've been able to find these kind of false negatives, if you like, so people they were rejecting that they could have been lending to, and allow them to lend to those. And so for them, it's a massive financial gain in terms of their revenue and their ability to lend more accurately.
Mm-hmm, mm-hmm. Sure, that makes sense. So, which brings me to another point that I just thought of. I mean, in the US, there's, cash flow data, bank account data is really becoming a must-have for all the lenders. And I mean, even some of the traditional credit bureaus are creating products that allow this kind of thing. And I'm curious about in the UK, because I mean, your focus is on the underserved, but to me, it sort of begs the question, well, why is it just that? Why isn't it for the already well-served? Because this information, bank account data, as you just pointed out, is richer than just getting the borrower, the previous credit data that is there. So, I mean, you say on your website, better credit for all, but then you kind of talk about the underserved. But isn't this really a bigger play than that?
Absolutely, yeah. I apologize if I didn't make that clear. I think for us, solving the problem for the underserved allows us to be better across the board. And so when I think about it, and I sort of imagine a spectrum of risk from super prime to subprime, generally you'll find that there are areas, pockets of risk across that spectrum that are currently misserved, and that can be right at the top as it can be at the bottom. And using our data to enrich those decisions is valuable at all those points. We do a lot of work in mortgage lending, for example, where understanding the financial ability and affordability of the customer is a huge pain point, and it's definitely not an underserved segment, but it's still a area which there's a massive improvement to be made on the risk capability of those decisions. So definitely we're providing for all. The sort of focus or view on underserved is that if we can get it right for what you'd argue is the hardest segment to reach, then we can get it right for everyone.
Right. Yeah, that makes sense. Okay, so last year at Lender Fintech Europe, you introduced a new credit risk score, the liquidity score. Why don't you explain a little bit about that and how that's different?
Absolutely. So liquidity is effectively the availability of funds in an account or a number of accounts for a consumer in any period of time, and it's one of the hardest things to understand from traditional credit reference agency data. So at the moment, some of the banks share sort of high-level balance data with each of the credit bureau, and that data effectively shows their kind of monthly closing balance, but it doesn't show how that balance was reached over the month and how that data sort of trends. So the most simple approximation you can understand, if you were to sort of look at your own P&L over a month, you'd see a line going from payday down to the end of the month, hopefully, and there'd be some kind of trajectory there. And what we're doing with the liquidity score over a month, 3 months, and 60 days, so sorry, a month, 2 months, and 3 months, is to basically predict where that direction of travel is going, and so that we can understand in a future-looking sense where the customer is likely to be and whether they're likely to stay positive. And that's obviously hugely important to understand whether a customer can afford credit. So rather than just sort of taking a static snapshot of the customer and saying, well, they've got money in their account so they can afford this loan. We're actually going to look at that and see, well, then maybe they've got money in their account, but we know that there's a recurring bill that's about to go out, and so that won't be there for much longer. And if you're going to lend them X amount, their repayment's going to be Y, and therefore they're going to need this much a surplus to afford that. And is that going to fit? And so it's a much sort of higher fidelity measure of the affordability, and it's a predictive, forward-looking measure.
Mm-hmm. Okay, that sounds cool. That's excellent. So another thing I saw, that this was announced a couple of months ago now, late last year. You had I saw this thing about ClearScore, which provides free credit scores, I think, to the. Maybe you can tell me exactly what they do, but they're partnering with you guys to serve underserved borrowers. So tell us a little bit about that relationship.
Yeah, so in the UK, a vast amount of credit is intermediated in some way. So people will typically go on price comparison services, or they'll search through different products to find the right solutions for them. And ClearScore is one of the largest businesses in that space. They have about 8 million customers in the UK, I believe, and they provide free access to the consumer's credit score. So in their instance, an Equifax credit score. One of the challenges they have is, obviously, for a lot of the customer profiles we've just talked about, they can't necessarily match the consumer to the right products, or even be able to find the right products for the individual. And also, when they're sort of providing recommendations and coaching and allowing them to understand how to improve their financial situation, a lot of those recommendations, if they're based on traditional credit data, aren't as bespoke or prescribed as perhaps they could be. And so our collaboration with ClearScore is aiming to tackle those challenges. So first and foremost, can we embed this new source of data into the decision-making process for the lenders that work with ClearScore, so ClearScore as the broker? Can we help them use that information to make more prescribed offers to their prospective customers? And then can we also use that information to help those customers coach or understand their own financial situation and move towards better financial resilience and better financial outcomes? Mm-hmm. So it's hugely exciting because it's one of the largest sort of credit marketplaces in the UK.
Right. Okay. So then I'm wondering about, when you're going out and trying to, sell this to lenders. I mean, I imagine, because I imagine you're obviously a lot smaller than the major credit bureaus. You're still a startup, I guess. But is the biggest sort of thing that you're trying to the thing you're trying to overcome, is it sort of the fact that it's a lot of work? Or I'm just trying to get a sense of this. To me, as you're talking, I mean, it's like this is a no-brainer, I feel like, for every lender to have. But, I take it you don't have every lender in the UK yet. So what is sort of what's the friction there that stops people from jumping on board?
We're certainly working on it. I think the challenge is quite interesting, because you're right, it is a no-brainer. I think for most, and we certainly get that response with almost every lender we speak to. The challenges are in terms of how you embed what is a completely new data source to many, how you get that data embedded into their existing decision process, right, in a way that meets their regulatory obligations, meets their compliance obligations, in a way that they're comfortable with. And obviously, with open banking data, because it's hinged on consumer consent, there's no sort of big historic data set that lenders have access to that they can kind of run some retrospective analysis on in the way that they would with traditional credit data before implementing some policy changes. Mm-hmm. And so we have to invent a new process for actually how you integrate this data into your lending decisions and get those benefits we've been talking to. And that's really where our business comes in, and how we help the companies we work with. So we already have a huge amount of expertise and a huge amount of data that allows us to provide this modeling service and allows us to provide these scoring services sort of out the box. But then we also have a huge amount of expertise in how we integrate these into existing models, how we provide that into a lending decision. We also have lending management software that allows people to interpret this data and triage cases and things like that. So the challenge is kind of how you, and I guess this isn't unique to us, it's kind of universal with financial services, how you sort of get through the inertia barrier and get this stuff integrated and start to kind of, as many venture capitalists say, sort of take a wedge and then expand it. And that's really the approach we've taken. And we've seen many of our customers sort of, in terms of where they were a year ago, over 1,000% growth in the amount of customers they're putting through open banking as a source of risk. So it is.
Right. Got it. Okay. So then did you find that, I imagine it's easier, like the fintech lenders are a bit more nimble, the peer-to-peer lenders, the online lenders, they're a bit more nimble, I imagine, than the traditional banks. Are they an easier sell than, I imagine, going to a traditional bank?
Yeah, I think that's fair to say. I mean, some of our earliest clients were in alternative finance and peer-to-peer lending, but increasingly over time that's changed. And I think one of the really interesting things to see is because open banking has kind of eroded some of the walled garden of transaction data that tier one banks have been sitting on for all this time. They've all realized that, sitting still is not a strategy, and they're trying to understand how they can, if HSBC is having to give this data away, how does it also benefit from this data as an input when one of their competitors' customers are switching to them? And that's meant that we're now seeing tier one banks, really move quickly in trying to build out new lending products using this information. And we're working with 5 or 6 of the tier one banks in the UK to do that.
Right. Okay. We're almost out of time. But a couple more questions before I go. Are you have any plans to expand beyond the UK? I know with Brexit now, it's a bit more challenging, I guess, to go over to continental Europe. But what are your expansion plans for international?
Yeah, we're definitely doing so. So we very recently launched in the Republic of Ireland. We're working in about 5 or 6 different geographies across Europe at the moment on implementation. The challenge there is that although PSD2, which is that piece of regulation I mentioned before, is in effect, we're sort of seeing this kind of slow adoption process that arguably we saw kind of a year and a half ago kick off in the UK. And so there is a sort of various degrees of readiness across Europe, but our ultimate goal is to build that level of interoperability, because what's really nice about this data set is it's universal. So, a customer from France can come to the UK and apply with the same data and get the same result. And there's a proper sort of passportability around the data. And so that's definitely something that we're eyeing up in the next year and a half as those APIs become sort of market ready.
Sure. So then what's on tap for this year? What's next for Credit Kudos?
So we're expanding pretty rapidly, and so a lot of that is going into engineering. So we're releasing a range of new features that allow more decision making to be done in-house using this data set. We were recently awarded a number of prize grants from the Treasury in the UK and the grant body Nesta, and they were looking at how new data and new technology can be used to deliver better decision making for alternative finance providers. And so through that work, we've built a whole range of new different scoring capabilities and new product features that we're rolling out, and we're now scaling those up for newer, bigger lending applications. We're also looking at the intermediary market. So that piece I mentioned in relation to ClearScore earlier, I think is a massive area of growth in the next year for open banking. Consumers generally like to shop around, and if they can use their data on a neutral platform to be able to shop around across the maximum amount of lenders in the market, then they're going to get best possible outcomes. And I think there's a really nice opportunity to almost flip the model and allow lenders to bid for the consumer's business based on their ability to assess that consumer's holistic data, and open banking being a big part of that. And so we're building a lot of the pipe work that's going to enable that in the next 6 months. So lots of big things, plus the expansion, plus new geographies. So we're very busy.
Interesting. Well, it's you're certainly doing some great work there, Freddy. I wish you the best of luck, and thanks for coming on the show.
Thank you for having me.
Okay. See ya. Sometimes I'm a little bit envious of the UK for their open banking initiatives they have, where banks have been made to connect or to make available their data through APIs to third parties, and we certainly don't have that here. But we are achieving some of the same goals anyway here in the US. I think that the power of cash flow underwriting, the power of banking data, I think has been proven here, and I would say it's now the norm, and I think it's going to become that way in the UK as well, because it just simply is a much more accurate way, as Freddy said, to underwrite borrowers. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye. Today's episode was sponsored by Lendit Fintech USA, the world's largest fintech event dedicated to lending and digital banking. It's happening on May 13th and 14th at the Javits Center in New York City. Lending and banking are converging, and Lendit Fintech immerses you in the most important trends of the day. Meet the people who matter, learn from the experts, and get business done. Lendit Fintech, lending and banking connected. Go to lendit.com/USA to register.